Let's turn back to the markets. Keith Lerner, Truist Wealth Co-Chief Investment Officer, joins us now. Keith, good morning. I wonder what you think the market requires at this point to maybe continue this advance. It's been a very rapid recovery, one of the most rapid ones historically. And now, I think people are mostly on board with the idea that things might turn out okay.
Yeah, well, great to be with you, Mike. I mean, we have used a lot of energy. Part of the reason why this market has rebounded is as you've taken out those recession risks, as the trade uncertainty index has moved down, the market has moved higher. But I still think this market deserves the benefit of the doubt. And one of the also reasons why this market has been so resilient is corporate earnings. We know going into the last earnings season that there was a lot of fear. And, there was only like about 9 companies that actually pulled guidance. So the question as we come into earnings season is what does that look like? I think it will be somewhat positive, especially as we've cut estimates once again as per normal ahead of this. So I think, Mike, maybe we need a little bit of consolidation after this big run up. But I think earnings will be the key. The other T, technology, will also be key. And we do have a little bit more clarity with the tax bill out there. So tariffs still matter, but they're not the only thing that matter.
Yeah, I guess the earnings picture, it's all going to come into focus pretty soon. It's no doubt the bar has been lowered pretty significantly as it was last quarter. But last quarter, you think about what was going on at this point in the month of April, in the first week of the quarter, and markets have been brutalized up until now. Now we're kind of riding high. I just wonder if the market is anchored to the new lower forecasts and has the capacity for upside surprise, or we're just assuming it's going to be good.
No, it's a great point. I mean, as we all always discuss, markets are all about expectations. And expectations for the market when you're at a 22 multiple has certainly risen. But I do think if you look at the last few months, we've seen the estimates for this quarter come down from about 9% to closer to 4%. So I think we will have an upside surprise. I mean, more importantly, will be how those companies react. But I do think at minimum that should keep kind of a bid or kind of support the downside. But we also have to remember, not only have we moved up 20% plus since the lows, just the last 2 weeks, we were up 5% for the S&P, high betas up 8%, small caps up 6%. So it wouldn't be unusual to take a little bit of a breather even during the earnings season, just to digest this. But again, I think this bull market has earned the benefit of the doubt. And even if it's a slower trajectory higher and with some hiccups along the way, I still think the trend is one that moves up over the duration of the year. But again, probably some hiccups, not as severe as what we saw in April.
How are we thinking about what's happening in the bond market and whether it's something that requires the attention of equity investors at this point? On the one hand, you've seen yields drift higher, but still in their range in general. Slight move higher in inflation expectations, market-based inflation expectations yesterday with the tariff news. But I wonder if you see that as a comfortable situation or a potential threat.
Yeah, I think it's both, Mike, right? It's comfortable right now because, as you mentioned, we're still largely in the same range we've been in. Our fixed income team sees fair value in the 10-year right kind of where we are today. If you started pressing towards the old highs, I think that certainly would put some pressure on the markets. When you look at the 30-year yields around the globe, you are actually seeing those press somewhat high. So at this point, it's something on the radar. It's not something for us to make a change yet, but that's certainly something that we're watching. And then going back to the Fed, this market has been pretty resilient despite the Fed being on hold. So a lot of debate whether we're going to cut in September or not. I think we will still likely see a cut, but I don't think that's the most important part for the market. I think it's going to come back to the earnings, the technology, and the resiliency of corporate America.
Keith, do you not feel like there's any fragility in this market? I mean, in your note, you talk about the bull just keeps charging, even though things are broken along the way. Can we really use history as a guide when there are so many cross currents at play? It just makes you feel a little nervous to say, well, the trend has been your friend, so let's just keep going this way.
Yeah, well, we definitely focus on the weight of the evidence. And the weight of the evidence, I mean, it's not all bullish. I mean, it's somewhat mixed where in our overall allocations, we're more aligned with long-term targets. So we're not, all the way to, pressing max bullishness here. But again, to your point, I mean, the first thing is after you have a 20% move in 2 months, historically, a year later, you tend to be up. 2, we're looking for more of a muddle through in the overall economy. That's fine. Valuations are relatively rich, but earnings are moving higher. And the technical trends, are somewhat improving. So you put that all together, I'm always nervous. I'm always worried about the downside, but I think at least you have to give the benefit to of the doubt and then have some things in the portfolio to hedge. We're more focused on large cap. We're more focused on growth. We do have fixed, some high quality fixed income, and we've been positive on gold all year long as well. So it's, I don't think it's an all or none situation. You should still have some hedges for some potential disruptions or more broken glass along the way.
Yeah, those rallies in the past, 20% in 2 months. I was looking at the history. Only the 1998 low did you really go right back to an all-time high, right? Usually it's kind of coming out of a bad bear market or it's within one. So I think the 98-99 scenario is kind of the bull's friend if it plays out that way. Keith, thank you very much.